Hi, and welcome to the next instalment of Solve's podcast series. Today, I'll be discussing three main tax benefits of having a self-managed super fund. So if you're somebody who's thinking about whether or not you want to step into the self-managed environment, or if you have parents, for example, who have a self-managed fund, you're thinking about becoming a member of their fund, or if you are just curious and are here because you would like to hear about what a self-managed super fund is, the top three, or maybe not the top three, but three key tax benefits from administering your own superannuation, hang around because there's a bit of information coming your way. So the first key tax benefit of a self-managed super fund is in accumulation phase, the contributions going into the fund that are what's called concessional contributions are only taxed at a maximum of 15%. That 15% tax rate also applies to the investment earnings of the fund. So that's a very low income tax rate. It's the lowest income tax rate that applies apart from individuals who are below the tax-free threshold, which is fairly rare in the whole of Australia. So onshore, a self-managed super fund is really the last legal, tax-efficient way for higher income people to save for retirement. And it's certainly one that if you're in a family group where there might be husband or wife that are a relatively higher income, say above 100 grand, and who have a relatively, maybe modest, but there's no hard line for the balance to start a super fund. I started my super fund when I had about 100 grand in the balance, and it's worked quite well over the years. So although there's no hard kind of bright line in the sand number, generally you want to have kind of a bit of experience with the super system. So a lot of clients who come to me are people who are in the retail environment, who have been working for a few years. They may or may not have a business, and may just be, like I said, a high-income employee, and they want more control and more visibility over their superannuation, what happens with it. There's been a number of high-profile situations lately, not just the Royal Commission, but other situations, the CBUS and so forth, where malfeasance among trustees has led to the public questioning the retail super system, and they should. It's a big system. There's around $4 trillion in it now. So that's a lot of money. And that money is being managed on behalf of the pool of Australian workers or pool of Australian savers and some retirees. And around about a quarter of that, around about $1 trillion, is in the self-managed environment, and the outflows are continuing to grow because people are questioning institutions. And if that's you, then you should reach out. You should talk to your accountant, talk to a SMSF administrator. You might want to go to our website, Solve Accounting, and download the information brochure on what a self-managed super fund is, how they work, how much it costs to administer, to set up, and to wind up. So to the first of my three key tax benefits, the 15% tax rate in accumulation phase. What that means is that on concessional contributions and investment earnings, the tax rate to the trustee is a maximum of 15%. There are a couple of exceptions to that. So if you're a high income individual, so if you have over 250,000 in income for what's called Division 293 purposes, then you have to pay an additional 15% on the concessional contributions for the year that you are over 250 for Div 293 purposes. But putting that to one side, it's generally a 15% flat tax rate for all concessional contributions and investment earnings inside the super fund. If you're a high income individual, what that means is that parking $1 inside a super fund will result in basically a 32% differential between your top marginal rate of 47% and the 15% tax rate inside the super fund going forward on all of the investment earnings from that dollar that are earned over the rest of your working life, up until generally you're 65, or until you hit 60 and retire, or until you hit some other condition of release. So that might not sound too appealing to people who, maybe some of you are not in the top marginal tax bracket. Maybe some of you think, I'll be dead by the time I'm 65. There's a bus around every corner. I want to spend the money now. That's fine, but the chances are that you won't be dead before you hit 60 or 65. The chances are you will live until then, and the chances are that it will happen a lot quicker than most of us imagine. So saving towards your retirement age in a largely passive but very low cost and low tax way is really important, because although you may have heard before of returns compounding, so compound interest, Einstein said it was one of the eighth wonder of the world. What the super industry understands that what a lot of you don't understand is that costs also compound. So if you can reduce a tax rate, and income tax being a key cost, if you can reduce a tax rate on your investment earnings from your marginal rate, which will generally be higher than 15%, down to 15%, in some cases that's a 32% benefit from investing through your SMSF rather than through you personally as the investment vehicle or a company outside of the super environment, any entity outside of the super environment. That is a huge benefit. So that would be the first of my 3 tax benefits. So the second of my 3 key tax benefits for investing through a self-managed super fund or through the super environment generally is franking credit arbitrage. Now, so arbitrage is a word it's a big word, but essentially what it means is a risk-free profit. So if you can generate profit, particularly cash profit, if that's possible, in a risk-free way, that is a huge benefit. Now, in the case of superannuation, specifically with a self-managed fund, that risk-free profit can easily be derived by simply rolling your superannuation balance from wherever it is now, say one of the big funds, CBUS, Hester, Australian Super is a big one, into a newly established self-managed super fund bank account. When that cash is in the bank account, let's say it's 100 grand, 50 grand, 200 grand, if all you do is simply buy a share in a company on the ASX that is paying a fully franked dividend, okay, so franking credits can be imputed on a dividend to the shareholders. Okay, so if the shareholder is your super fund, and let's say it's buying a share in a supermarket or a bank or Telstra or whatever company that you decide is right for you to invest your super in, when the dividend is declared by that investee company, typically there will be an attached franking credit. And think of a franking credit as basically a tax credit. So that tax credit is attached to the dividend that is paid to your super fund at the large company rate, which at the moment is 30%. So you've got an amount of income coming into your super fund that has a tax credit at 30% attached to it. Now, back to the first point, which is that the super fund on its investment earnings only gets taxed at 15%. So the difference between the taxation rate inside the super fund of 15% and the franking credit that is imputed on the dividend on the share that is held by your super fund in the bank or the supermarket is 15%. So the tax rate differential between the payer and the recipient, your super fund, is an immediate 15%. Now, that excess franking credit is cash refundable to the trustee of your super fund. So I'll say that one more time. The difference between the tax rate of the payer, the investee, so whatever company your super fund is invested in, and the recipient, the trustee of your super fund, is 15%, being the 30 less the 15. That excess is cash refundable from the ATO to your super fund. Now, there have been attempts in the past, political attempts, mainly in the 2019 election by Bill Shorten, to eliminate the cash refund of excess franking credits. That crashed and burned. So we believe that that idea is off the table for the foreseeable future. But at the moment, there's no proposal to reverse that law, as much as I believe the current Labor government would like to do so. So for now, the refund of excess franking credits into the super fund is live and appears to be an enduring benefit that you can avail yourself of. That is what we refer to as tax arbitrage. So a risk-free profit from a tax rate differential based on very simple things that are hiding in plain sight. As a continuing Australian resident, which you have to be a trustee of a self-managed super fund, you can easily avail yourselves of that risk-free profit simply by having a self-managed fund that invests in fully franked dividend-paying shares. I think the big four banks, they're the most common one. It's very easy to do. Most people, think that you have to commercialize some innovation to become rich. People might look at guys like Steve Jobs or Elon Musk and think, I can never do that. Well, you don't have to do that. That's the first thing. You don't need billions of dollars, and you should aim for a kind of a smaller bar, if you will. A few million will do it. And over the course of a working life, even on a relatively modest income, if you establish systems, and I believe the self-managed super fund is one of them, that are simple and that are low cost, and where you can repetitively benefit from an obvious situation. In Australia, it's full dividend imputation. Over time, you can become very comfortably wealthy. You don't have to find the next Google or the next Facebook. What I refer to it as, if you go to the website, again, I've written an article, a blog post in there on haystacking. So what you want to do is you want to get to a point where you have enough haystack so that your retirement income is guaranteed pretty much beyond doubt. For me, that number might be different to what it is for you, but with most clients, you will try to get their partner couple to around about $2 million each. And then you can even join the adult children into the fund, and then start investing on behalf of those children as well, if that's what you choose to do. So once you get there, that will guarantee you 5%, 100 grand plus a year is pretty easy for both yourself and your husband or wife until you're dead. And that is the beauty of part of the beauty of having a self-managed super fund, is that you can really craft a vision for your family group's financial position in the future. You can look forward into the future with confidence. If you hit, as you work towards whatever limit it is for you, it might be less for some people, be more for others. But whatever it is, using a self-managed super fund to get there forces you to engage with the investment process. It forces you to learn about how franking credits work, about how markets work, which is the opposite of having your money in a defined benefit plan or a retail account, where you basically outsource all of the thinking and all of the activity to a trustee. It's very hard to hold accountable. So that's kind of my second benefit is franking credit arbitrage or risk-free profit from a tax rate differential inside the SMSF. Very easy to achieve. The third key benefit of running a self-managed super fund is when you hit the retirement phase of the account. So when you hit 60 and elect to retire, or when you reach the age of 65, generally. There are other conditions of release, but we'll just deal with hitting 65 or hitting 60 and retiring. At that point in time, the tax rate inside the super environment, whether you're in retail or self-managed, goes down to zero. So the income tax rate for the fund drops to nothing. What that means is that all of the income coming into the trustee of the fund, so let's say that it's from dividends on shares in the Commonwealth Bank, all of that income coming in up to a certain limit, what's called the transfer balance cap. So there are limits, but the taxation principle is that as soon as somebody hits retirement phase, that there is zero income tax on the income inside the fund. And the policy logic behind that part of the law is that if you have planned your life and worked towards a situation where you don't need to go to the federal government with your hand out to collect a welfare payment, a pension, the government will reward you with tax-free status because you've taken financial responsibility for your own future. Now, in that case, if you're lucky enough to get there and you've got income coming into the fund, the income from the investee company is tax-free to the trustee of the super fund, zero tax. And then it's also exempt from income tax when it's paid out to the member as a pension stream. So I'll go through that one more time. The chain is that if the super fund holds a share in a bank, pays $5 a year fully franked dividend, that $5 plus the franking gross up that's attached to that dividend is exempt from tax to the trustee. So the trustee of the super fund pays no tax on it. And then when the trustee passes that money through to you, like a conduit almost, as a pension stream, that pension stream of income to yourself, the member, is also exempt from tax to you. So right the way from the source of the payment all the way through to the member is exempt from tax. What does that mean? Well, to a fund administrator like myself, so we administer funds at Solve. I administer quite a few now. So when a fund, a self-managed fund that is in pension phase, receives a franked dividend from an investee company that it holds shares in, the franking credit on that dividend is fully cash refundable to the trustee. So for every 70 cents in dividend that you receive, 30 cents is paid to you from the ATO as the trustee. So if you only get 70 cents in cash dividend, you actually, after the tax return is lodged, end up with a full dollar. So another 30 cents in income from that distribution. Then you can pay out that full dollar to the member who's in pension phase, tax-free to the member. So not only do you not get taxed on your investment yield, but the member does not get taxed on the cash distribution when it's paid out as a pension phase income stream. So that's really huge. And it does take a bit of foresight. I mean, even myself, like I'm 43. So yeah, there's another 22 years until I get to the point where I can benefit from that. And I've already been doing this for well over a decade myself. So it does take foresight. And like I said, like one of the really great things that I love about working in this space and working with clients is that when they transition into the self-managed environment, it really forces not only them, but their children and people around them as well to really take an active interest and to really take responsibility for their financial future. It forces them to have conversations with each other about what their vision is for their family group? What do they actually want to achieve out of this job that they're working, or out of this company that they're building, out of this business that they're trying to grow? What do they actually want to do with the profit from that business, and how can they do it? And it's quite rewarding to see people realize that they can achieve great things with their money, that they may not have previously turned their mind to that possibility, or it may be opening their mind to more possibilities than what they thought were possible. And that's fantastic. So if you're watching today and you want to go down that pathway, I'd be happy to hear from you. You can go to our website, solveaccounting.com.au, and fill in the contact form, or you can send me an email. I'm Chris. And we also have a info brochure on the website about establishing, running, and winding up self-managed super funds. So please head over there, have a look at the information, have a look at some of the links that I've got on my part of the website that deals with self-managed super funds. Have a read of some of that information. And if you want to reach out to me, I'm a pretty accessible guy. You can send me an email. I'd be happy to hear from you.